Are you kind of tired of all the Wall Street hype and, the super risky bets? What if there's a time-tested investing strategy that puts safety way ahead of speculation? Well, today, we're going to unlock the secrets of Benjamin Graham's playbook, which he designed for the everyday investor, not some financial genius.
I mean, this is the big question, right? How can you and I actually build wealth without getting totally burned by the market's crazy swings or trying to predict something that's, unpredictable? It's a puzzle a lot of us are trying to solve.
And Graham's answer to that puzzle is pretty profound. He taught that the key isn't about guessing what's next or trying to outsmart everybody else. No, the real secret is building a defense, a fortress, really, around your money.
Okay, so let's dive into this. First, we need to understand who this strategy is really for. See, Graham wasn't writing this for the hedge fund guys. He wrote it for a very specific kind of person.
He called this person the defensive investor. This is someone who has limited time, who isn't a full-time financial analyst, and who honestly values a good night's sleep way more than chasing some risky, high-flying stock. If that sounds anything like you, then this framework is going to be your guide. So, what's the one core principle that guides this defensive investor? Well, it all comes down to maybe the three most powerful words in finance, coined by Graham himself.
The margin of safety. The whole idea here is to shift your focus from, hey, how much can I make, to how can I make sure I don't lose? It's the ultimate defense against speculation, and it's the foundation for everything we're about to talk about.
And to put that margin of safety into practice, Graham created something brilliant, a practical, step-by-step tool, a 7-point checklist to filter out risk and pinpoint solid investments. So think of it like this. It's basically a series of gates. And here's the thing, a stock doesn't get a pass for clearing 6 out of the 7 gates. Nope, it has to clear every single one. Each gate is specifically designed to weed out a different kind of risk. The first 2 gates are all about raw strength and stability. Rule 1 demands the company be big enough, because let's face it, larger companies have more resources to survive economic storms. Rule 2 demands a strong financial position. Current assets have to be at least double the current liabilities. This just ensures the company has a solid cash cushion and isn't drowning in debt. Next up, rules 3 and 4. These are all about consistency. Graham wanted to see at least 10 straight years of making a profit and, this is crucial, 20 years of uninterrupted dividend payments. Why? Because a long history of paying out dividends shows a company is resilient and it's committed to rewarding its shareholders with real cash, not just some numbers on a spreadsheet. And rule number 5, it's this really simple but honestly powerful check against a company just stagnating. It requires a pretty modest 1/3 increase in earnings per share over the last decade. See, this isn't about chasing explosive growth. It's just about making sure you're investing in a business that's actually moving forward, not slowly dying. Okay, now for the all-important valuation checks, starting with rule number 6. The price you pay should not be more than 15 times the company's average earnings from the last 3 years. This is a hard and fast rule to stop you from overpaying, no matter how great the company seems. And the final gate, rule number 7, is just a genius little check on valuation. It combines 2 key metrics, the price-to-earnings ratio and the price-to-book ratio. You can think of PE as what you pay for profits and price-to-book as what you pay for the company's actual stuff, its net assets. By multiplying them together and keeping that final number under 22.5, you make sure you aren't overpaying on either front. It keeps your investment firmly grounded in reality. So, you might be wondering, does this incredibly strict checklist actually work in the real world? Well, Graham put it to the test himself. He applied it to the 30 biggest, most famous blue-chip stocks of his day, the Dow Jones Industrial Average. And the results? They were absolutely staggering. Of those 30 titans of industry, only 5 passed all 7 of his criteria. Not 20, not 10, just 5. That really shows you just how tough and how powerful this filtering process truly is. And here's what's so telling. The 5 companies that made the cut weren't just okay, they were demonstrably cheaper. They had a much lower average PE ratio and price-to-book value than their peers, which offered a clear margin of safety that the other 25 companies just didn't have. You know, this framework can do more than just help you pick individual stocks. Graham showed how it could actually identify entire sectors of the market that were offering way better value and safety.
Back in the early 1970s, his analysis showed this really stark contrast between two major sectors. On one side, you had your industrial companies, and on the other, you had public utilities. For the defensive investor, the choice was, well, it was crystal clear.
I mean, the data here is just undeniable. Utilities offered a lower valuation, nearly double the dividend income, and had similar growth prospects to industrial stocks. Just think about that for a second. More cash in your pocket, a cheaper price tag, and basically the same growth. It was a classic heads I win, tails I don't lose much situation. A perfect example of finding that margin of safety.
But okay, that was 50 years ago. So how do we adapt these timeless principles for today's hyper-fast, super complex market? Luckily, modern commentators have kept Graham's wisdom alive and well for us. Financial journalist Jason Zweig gives us a really critical warning here. See, Wall Street loves to use something called a forward PE, which is based on estimated future earnings. But as Zweig points out, those forecasts are notoriously wrong. Graham's method of using actual historical earnings, it's still the safer and, frankly, more intelligent path. Zweig also highlights a very modern risk: crowded trades. If a stock is over 60% owned by big institutions, it's not some undiscovered gem. Worse, if they all decide to sell at once, like the Rockettes all kicking at the same time, it creates a stampede for the exit, and small investors can get absolutely crushed. So here's the bottom line. Even with powerful modern tools that can screen for Graham's criteria in seconds, your work isn't done. The checklist gives you a list of potential investments, but it's up to you to do the real homework. That means actually reading the company's annual reports to understand the business, checking the proxy statements to see how management gets paid, and making sure the numbers you're seeing are backed by real, sustainable performance, not some clever accounting tricks.
Which really leaves us with this final thought. In a market that's obsessed with speed, with speculation, and with finding the next big thing, maybe the greatest advantage isn't being smarter or faster. Maybe, just as Benjamin Graham taught us all those years ago, it's simply having the discipline to be patient.